The fiber optic cable sending you this video is a legacy buried by a bankrupt telecom company. One click. A box at your door by morning. Video that never buffers. A cloud always on. Beneath all of it, deep in the ground, glass threads carry light at full speed. In 2000, 9,000 internet companies were born. Then they disappeared. The greatest winner rose from the wreckage. That one winner now delivers boxes to your door. The money of bankrupt investors paved that road. Almost no one knows this. 1993. A 22-year-old student sat before a computer at the University of Illinois. Earning $6.85 an hour writing code, Mark Andreessen built the world's first browser to display images and text on a single screen. It was called Mosaic. Until then, the internet belonged only to universities and the military. That code caught the eye of Silicon Valley veteran Jim Clark. Clark put up $4 million. Two men founded Netscape. August 9, 1995. The company listed on NASDAQ, 16 months old, never profitable, not once. Controlling 70% of the browser market, with no revenue model in sight. The original IPO price was $14. The night before listing, the underwriter doubled it to $28. Opening morning, a flood of buy orders froze the trading system. After 2 hours of delay, the first trade went through. First trade price? $71. Closing price? $58. Market cap hit $2.9 billion in a single session. The Wall Street Journal wrote, General Dynamics, a defense contractor, took 43 years to reach $2.9 billion. Netscape, with no revenue, took 1 minute. The lesson capital markets absorbed was simple. Profit doesn't matter. Capture traffic first. The internet is winner take all. This lesson produced every mania of the next 5 years. U.S. venture capital investment in 1995, $6.3 billion. 1997, $11.4 billion. 1999, $38.2 billion. 2000, $89.8 billion. 14 times in 5 years. The equivalent of 1 full year of American teachers' salaries poured into website addresses. This was not capital expansion. It was the moment capital began chasing expectations instead of pricing value. The market lost its normal allocation mechanism. That money wasn't buying revenue models. It was buying eyeballs. Companies that attracted attention became worth more than companies that made money. How many people clicked? How many page views did it generate? Wall Street called this the eyeball economy. Morgan Stanley's chief analyst Mary Meeker was its architect. Traditional profit and cash flow became outdated metrics. Something strange was happening. The more you sold, the deeper the loss. But the deeper the loss, the more the market believed in your future. Losses weren't a signal of failure. They were packaged as advance investment in monopoly. The internet runs on network effects. The company that captures users first dominates forever. Today's losses are the cost of tomorrow's monopoly. This was the seed paradox. And this paradox became the engine of the bubble. The more investment came in, the higher the valuation climbed. The higher it climbed, the more you had to sell. Capital had no reason to stop this cycle. January 1999. Julie Wainwright took the CEO seat at Pets.com, a company that would sell pet supplies over the internet. Amazon invested $10.5 million for a 54% stake. Additional rounds brought total funding past $110 million. January 30th, 2000. 30 seconds of Super Bowl airtime, $1.2 million. A sock puppet dog appeared on screen. That Super Bowl was called the .com Bowl. .com companies competed for ad space. The sock puppet made Time magazine and People magazine interviews. In 1999, Pets.com's net revenue, $620,000. That same year, ad spend, $11.8 million. Total marketing, more than $70 million burned. More than 100 times revenue went to advertising. The sock puppet became famous. So did the company's losses. Customer acquisition cost, over $100 per customer. Average order value, $37. The shipping cost on a 40-pound bag of dog food, fully absorbed by the company. The more they sold, the deeper the loss. The more orders came in, the bigger the hole. To turn profitable, they needed an additional $260 million. They had $180 million on hand. Pets.com was the face of the bubble. Funny, flashy, fast-burning. But Webvan was more important. Inside it was how the bubble misjudged the world. That same November, George Shaheen left his seat as CEO of Anderson Consulting. A $4 million annual salary, a heavyweight, left for a 3-year-old grocery delivery startup. The Wall Street Journal wrote, "Traditional economy surrenders to the digital economy." Shaheen's contract locked in a lifetime annual pension of $375,000. Webvan's plan was grand. Build cutting-edge automated distribution centers simultaneously in 26 cities across the country. Each center handles the throughput of 18 supermarkets. They contracted construction firm Bechtel. Cost per center, $25 to $35 million. With venture capital and IPO proceeds, they held nearly $1 billion. Webvan's market cap exceeded $10 billion right after IPO. Code could be replicated infinitely, but refrigerated vans hauling 40-pound bags of dog food, they couldn't. Automated conveyor belts and computer-controlled rotating racks filled the warehouses. But actual order volume never reached 20% of designed capacity. They operated in 9 cities. In 2000 alone, $453 million in losses. In 1999, 2 IPOs per trading day on NASDAQ, companies with no real substance. Total IPOs that year? 457. Investors didn't ask what the company sold. A .com in the address was enough. No revenue, no business model, just a domain name. Dentists tracked NASDAQ tick charts on their office monitors. Taxi drivers recommended .com stocks to passengers. One driver introduced himself as a full-time day trader temporarily behind the wheel due to bad timing. A news story ran about an accounting firm employee who quit with $200,000 of his grandmother's inheritance and jumped into options trading. He mocked warnings from professionals. Even the mania had its own logic. Cyber Rebate promised to sell goods below cost and return 100% of the purchase price later. No cash flow. But the stock climbed. Cosmo.com pledged to deliver anything within 1 hour inside cities. Even a single ice cream. No delivery fee. The delivery worker's wage cost more than the ice cream. By end of 1999, daily stock volume in U.S. individual investor accounts had tripled compared to 1997. Full-time day traders numbered in the hundreds of thousands. Online broker E-Trade's ad ran during Super Bowl prime time. Brokerages lowered commissions to encourage more trading. Amateurs entered the market and sat in front of the same screens as professionals. This mania didn't burn only inside the stock market. Across the Atlantic in Europe, the same dream was purchased this time with debt. Spring 2000. The British government auctioned 3G mobile spectrum. Expected revenue, £1 to £3 billion. After 150 rounds of fierce bidding, the final winning bid, £22.5 billion, roughly $34 billion, more than 10 times the estimate. This was not a triumph. It was buying an entry ticket to a world that hadn't arrived yet, mortgaging a decade of future profits. Germany's auction that August. Total bids, €50.8 billion. Total European 3G auction receipts, over $100 billion. Telecom companies borrowed every penny. That debt consumed the capital needed to build towers. They bought spectrum, but had no money to build networks. BT was forced into a £5 billion rights issue and had to sell its mobile unit, O2. Deutsche Telekom and France Telecom's credit ratings were downgraded to just above junk. Europe handed the first infrastructure of the mobile internet age to America. March 10, 2000. The Nasdaq Composite hit 5,048 points. Intraday high, 5,132. April. Microsoft antitrust ruling delivered. Inflation fears and margin calls on leveraged investors collided. For the first time, capital looked over its shoulder. Once the direction flipped, there was nowhere to stop. When the funding dried up, companies' true faces were exposed. Cash meant survival. No cash meant death. Right now. No time to ask about the business model. November 7, 2000. Pets.com shut its doors. Orders stopped. 255 employees fired. Stock price that day, $0.19. 9 months after the Super Bowl ad. Not enough time to bring a child into the world. And it was gone. 268 days listed. One of the fastest collapses of a major listed company in U.S. capital market history. The sock puppet vanished from TV. Julie Wainwright became one of Silicon Valley's harshest targets of blame. That same year, her husband filed for divorce. From Q4 2000 through H1 2001, .com companies vanished at a rate of 1 per day. Cosmo.com, Boo.com, drcoop.com, Garden.com. Companies that had spent tens of millions on advertising shut down their sites. Employees were notified of layoffs via a single email. Domains sat empty on servers. July 2001. Web vans ceased operations. 2,000 employees hit the street. At time of bankruptcy filing, total assets recorded at $1.2 billion. Actual liquid assets, almost none. Once $34 per share, $10 billion market cap, the stock closed at 6 cents on the day of bankruptcy. Shaheen's lifetime pension contract became scrap paper in bankruptcy court. He stood at the back of the unsecured creditors list. Recovered cents on the dollar, almost nothing. The automated conveyor belts and hundreds of refrigerated vans sold at auction for a fraction of cost. Founder Louis Borders personally bid $2.5 million for the company's core software. Nasdaq didn't stop there. After the September 2001 attacks, the index fell to 1,423. June 2002. WorldCom's $11 billion accounting fraud exposed. October 9, 2002. Nasdaq bottomed at 1,114. 78% collapse. Capital equivalent to Japan's entire GDP evaporated from the stock market. 862 .com companies ceased to exist. Here's what matters. Not everything disappeared. In the wreckage, fiber optic cable laid by bankrupt telecoms remained. Global Crossing, $47 billion market cap in 1999, bankrupt by 2002. WorldCom, the largest bankruptcy in U.S. history, $11 billion in accounting fraud. Shareholders' money evaporated. But the cables they drilled through the earth didn't rot. As of 2001, actual data flowed through only 2.7% of fiber optic cable laid nationwide. A 100-lane highway built, with only 3 cars driving. The other 97% lay dark underground. Between 1998 and 2001, U.S. telecoms poured $90 to $120 billion into laying fiber optic cable. Bankruptcy was not an end. It was a transfer of ownership. One man watched that wreckage. Jeff Bezos. In 2000, Amazon stock fell from $107 to $7, 93% down. Bezos told investors, "Our probability of success is 30%. And by success, I mean returning your investment." What saved Amazon was not faith alone. It was cash, enough to survive. At the peak of bubble fever early 1999, Bezos issued $2.2 billion in convertible bonds. Maturity, 2009. He secured bunker money 1 month before the bomb went off. End of 2000 cash and marketable securities, $1.1 billion. While other companies begged for new funding and shut down, Amazon held on. June 2000. Lehman Brothers analyst Ravi Surya published a sell report. He wrote that Amazon faced severe credit stress and would soon go bankrupt. The day the report dropped, the stock fell 20%. Amazon entered restructuring. Capital expenditure cut by more than 60% year over year, focused on operational efficiency. 2002. Amazon posted its first annual free cash flow surplus, $135.1 million. Bezos didn't stay on defense. The bubble's collapse was Amazon's historic bargain sale. Talent, data, and technology from bankrupt companies flooded out. Webvan's key logistics executives moved to Amazon. They acquired the customer database of bankrupt software distributor Egghead. Webvan's logistics executive Mick Mounts carried the lessons of bankruptcy and founded robotics logistics company Kiva Systems. In 2012, Amazon acquired it for $775 million. Kiva became Amazon Robotics today. Webvan's failure became the DNA of the robots running through Amazon's warehouses. They acquired MobiPocket, an e-book software developer. 2 years later, the Kindle launched. Bankrupt assets built Amazon's next decade. It wasn't saving an industry. Turning rubble into opportunity required more than insight. The first requirement was survival capital. Buy what you need most, when prices are lowest. When blood was everywhere, Bezos kept shopping. Global Crossing's fiber backbone, laid on debt, transferred to Level 3 Communications with liabilities discharged. A $47 billion company's assets acquired for $3 billion. Level 3 was later acquired by CenturyLink, now renamed Lumen Technologies, WorldCom's U.S. wireline network. Verizon acquired it in 2006 for $8.5 billion. Amazon turned its attention to this dark fiber. Sun Microsystems servers flooding out of Bankrupt.com offices went to auction for pennies. Network bandwidth and computing resources became available at prices incomparably lower than the past. 2006. AWS launched. Cloud computing grew on infrastructure poured by 9,000 companies. Bankrupt Telecom fiber connected the servers. Servers held startups' data. Companies that couldn't afford to build data centers used AWS to change the world. If there had been no dot-com bubble, AWS's initial capital costs would have been unmanageable. The very business Webvan failed at in 18 months. Fresh grocery same-day delivery. Amazon put its hand back into that business. 2017. They acquired Whole Foods Market for $13.7 billion. Amazon Fresh launched. Exactly the same business as Webvan's vision. The difference was one thing. In 2017, there were smartphones. Prime membership existed. Machine learning predicted strawberry demand separately for New York and Seattle. Webvan's vision arrived 17 years too early. Timing was everything. And Amazon already held Webvan's talent and patents in hand. The Pets.com sock puppet trademark sold for $125,000 after bankruptcy. The buyer, Barron, a subprime auto loan company. The puppet reappeared on TV. Everyone deserves a second chance. Alongside copy pushing high-interest loans to people with bad credit. The Pets.com domain sold cheap to PetSmart, an offline competitor. Today, that address still redirects to PetSmart's site. 2024. AWS's global cloud market share, 30%. Second, Microsoft Azure at 21%. Third, Google Cloud at 12%. AWS annual revenue alone, $107.5 billion. Amazon's market cap exceeded $2 trillion. More than 1/4 of all capital evaporated during the dot-com bubble was recovered by a single company. Amazon's logistics warehouses, 1,200 worldwide. More than 1 million robots. They directly handle 25% of U.S. domestic parcel volume, surpassing FedEx and UPS. The 97% of fiber optic cable that lay dark in 2001 is now lit. The exploding bandwidth demand of AI data centers filled it entirely. Now we have to search for new dark fiber. The light was hope when first switched on. Capital poured in, and it became flame. The flame burned the server rooms, and the power in the server rooms went dark one by one. But the light buried underground, that didn't disappear. Bankruptcy courts changed the owners. The switch passed to fewer hands. And those hands still set your delivery times, your server costs, the rules of your platforms. That is the world greed built.